rattling out numbers about how much SIP has increased over the past several years. In fact, how much assets under management have increased. From 2010 to 2013, we saw them crawl between 5 lakh crore and 6 lakh crore. But from 2014 to 2016, we saw them double from 7.5 lakh crore, or actually 7 lakh crore to 17 lakh crore.
Yeah, 18 lakh crores is the last number, I think, and it's only growing. Every day we're getting investments into mutual funds. So let's invite some of our best fund managers. We have, of course, Anup Maheshwari, Nilesh Shah, Navneet Munot, and Sunil Singhania all joining us. Sunil, let me start with you. How to choose a right mutual fund, because ultimately it boils down to that. We're talking about a lot of mutual funds beating index. We're talking about a lot of mutual funds giving 25%, 30% CAGR. But truth be told, there are laggards as well. So how to choose the right mutual fund?
So I think I'll give you a different perspective to it. Unfortunately, an equity investor in India invests 2% of his net worth in equity and wants to make 100% on it. And wants to churn every week, every month or so on. So I think the better thing to do is allocate properly, and whether then a mutual fund scheme gives you 28% or 32%, it's not going to matter too much. However, we get fixated a lot by these numbers. And our view is that, and I gave that example in the interview, that the way a Kohli or a Tendulkar or a Steve Smith is not going to hit a century every day, the same way each of us would not be the best fund manager or the best scheme every single day. So I think you have to look, as Madhu said in the previous panel, that you have to look at the longevity of the fund manager, you have to look at their experience, you have to look at the track record, and then just zero down on 4 or 5 good fund houses. I think you're set.
That doesn't entirely answer the problem of an investor when he's looking at, at least about 50, 60 funds. All of them are equity mutual funds. Or you have 50, 60 debt funds. So, Navneet, to you. You have, of course, a lot of, websites, CRISIL, Value Investor, which give you, 10-year average returns, 10-year best performing first 10 funds, 5-year best performing top 10 funds, 3-year best performing, 7-day best performing, 7-month best performing. I mean, it's damn confusing, yaar. There are some common elements. But which one should you look at?
So somebody early in my career, and the gentleman sitting here told me that you guys are like pharmaceutical manufacturers. So you have the antibiotics, you have the painkillers, you have the syrups, everything. And then I'm the doctor. For the investor, I'm saying that I'm the doctor. And based on what he exactly needs, then I choose that what is that I need to buy from each one of the manufacturers. And how he does it, basically you need to do it like 2 major things, a risk profiling and then your overall goal setting. So you are at, let's say, your kid is at 4-year-old and you know that he'll need certain money if you want him to send to university at the age of 20, 16 years. You have that much of money and you need that much of money. This is what you can save. This is what you need for that specific goal. And then risk profiling is important because it's easy to say that, equity does great, but you have a 2008, it can go down by 60% also. If you are investing money for 2 years, not a great idea to put all the 100 rupees in equity alone. So then you look at all of us have certain emotional biases, cognitive biases. Understand yourself and then look at your goals and then decide which asset you need to put how much money. And within that, maybe then you choose the right fund, which basically matches the asset allocation that you need and then the right profile. According to your profile, the right kind of funds are chosen.
Okay. Anup, mutual fund industry is also facing some challenges. One of the best funds of your house, DSP Micro, Blackstock Microcap, has actually stopped fresh investments, right? So there's a bit of a challenge now with so much investments. How are you going to manage with so much money?
That's a nice problem to have, actually. But I think the challenge in that particular product is the space that it invests into. By its very nature has relatively less liquidity. The level of risk that you're taking is a lot higher, obviously. And clearly what you don't want is to set wrong expectations for investors coming in. Because, a lot of investors look at your past recent performance and then, sort of come into the product. So we just wanted to set expectations right. Also the fact that liquidity is a bit of a challenge in this environment. So we'd like to not have a situation where, because of the money flow coming in, you're influencing prices in a non-fundamental fashion. So the thought was just let's take a pause. It's a fairly decent size for the space that it's investing in. And, at the appropriate time, hopefully we'll open it again.
Well, let me go back to the question which I think still needs a little more fleshing out in terms of how do you choose? Nilesh, how do you choose? Or should you choose the fund manager rather than the fund? Which means, have a portable system where you're going to go with the fund manager if he were to change jobs.
Out of all these three, I probably have worked in more mutual funds. And despite my leaving, all those companies have continued to do well. So by not chasing fund managers, you have made money. And if you had chased me, you would have also made money.
Oh, wow.
So the limited point, Lata, here is that if you have to go from Mumbai to Delhi, there are multiple modes of transport available. You can take as many trains, as many buses, as many cars, as many flights. Point is that you should begin the journey. Now, maybe in plane you will reach faster, but you won't enjoy the fun of, eating batata pova or vada pav on the street. But if you pick up a train, you'll probably take a little longer to reach, but you will enjoy the journey. So just begin the journey. It doesn't matter in which mode you are. If you have a balanced, some amount of mode, then anyway you will be able to reach there. And as Madhu mentioned, and Navneet mentioned that if you don't have that capability, please go to the distributor, please go to the advisor. They will know which funds to choose, they will know which allocation to make, and that will hopefully create a reasonably good journey for you.
Okay, well, let me get that to Anup as well. Anup, is there, for equity mutual funds, why, for that matter, even for debt, is there a more reasonable period? Should I look at a 10-year return? What is a good way to judge a fund?
So I think, good way is probably the way we look for companies to invest into, is possibly a good way to invest the fund itself, which is you normally look for very stable managements who have a track record of creating value through time, who have a very defined vision of where they want to, so in this case, an investment philosophy perhaps, and obviously the right integrity, ethics, etc. So our mutual fund has been very fortunate that we are blessed with a number of players which sort of meet that criteria. So there's a good amount of selection available. But, I always feel, given all those factors, if you identify a fund house or a few fund houses that you like, you're probably better off selecting the worst performing fund in that fund house at a point in time rather than always chasing the best performing fund. Because it's the same team, it's the same philosophy, it's the same style. It's just that maybe that product or that group of stocks have not performed for a while, and that actually creates potential for them for the future. So I think this sort of, most people tend to look at the last 1 year and 3 year performance, and it works through time sometimes, but I think a way to increase those returns are actually to look at the underperforming parts of the same fund house and actually investigate more into those funds than just buying what has already performed. Interestingly, if I can just add to that, we did one analysis. If every year for a certain period of time you chose the two best performing funds of the previous year, and you kept changing your portfolio every year versus choosing the two worst performing funds of the previous year, you'd always have a better outcome of the worst performing funds through time than the better performing funds.
Okay, so the law of averages may be playing out.
It works, yeah.
Okay, it works.